Welcome to this brief analysis of the emerging market scenario. 2018 was a disappointing year for stock market investors, disappointing globally. All the global indices were negative with only a few exceptions. The Morgan Stanley All Country Index declined by 9.5% in local currency in 2018. Morgan Stanley Emerging Market Index declined by 12.3% in local currency in 2013. Compared to that, India's indices performed better with the Sensex giving more than 5% returns and Nifty giving more than 3% returns. But the broader market performance was indeed very poor. But 2018 is behind us. Let us look forward to the prospects in 2019. In the present juncture, the prospects for stock market investors in 2019 appear very bright, mainly because of three reasons. First, globally, we are expecting an economic slowdown in 2019. US has already shown signs of slowing down. For China, this year's economic growth rate will be the lowest in the last 28 years. Economic growth in Europe is moderating. So we have a slowdown in the global economy in 2019. That is the backdrop right now. In such a context, central banks will be following a dovish monetary policy. Rate hikes will be very remote. So rate cuts are possible. So as far as the emerging markets like India are concerned, 2019 will be a year where we will be getting a lot of foreign portfolio inflows. That augurs well for our markets. From India's specific economic perspective, we are on the cusp of a spurt in corporate earnings in the coming year. This year, we will be growing at around 7.5%. I'm talking about 2019-20. So that will be the fastest growth among the large economies of the world. And financial year 20 is likely to produce a Nifty earnings growth of more than 20%. The market will start discounting this sharp spurt in earnings growth. This more than 50% of this expected earnings growth is likely to come from corporate banks. So corporate banks are, that is the reason why corporate banks are very resilient in the market. Even when the markets are sometimes sluggish, corporate banks are looking very resilient. Both the leading private sector corporate banks as well as the leading names in the public sector. Again, another very important favorable factor from the market perspective is the likely cut in interest rates in 2019. Inflation last year undershot RBI's estimates. We began with an inflation target of more than 5% and we ended the year with an inflation of around 2.13%. So with the repo rate at 6.5% and inflation at 2.13%, real interest rate in India is perhaps the highest among emerging markets in the world. So this leaves a lot of room for the RBI to cut interest rates. 2 rate cuts are possible of 25 basis points each. 1 rate cut is for sure. So RBI is likely to move from the present monetary stance of calibrated tightening to a neutral policy in the February monetary policy, and by April the RBI is likely to shift to a dovish monetary policy with financial accommodation and cut in interest rate. That augurs well for the markets in 2019. But then since these positives are there, the markets will do well, but that does not mean that it will be a very smooth bull ride for the markets in 2019. There will be many hurdles in the path of the market, like the approaching budget to be announced on the 1st of February, followed by the crucial elections to the Lok Sabha expected in May 2019. Particularly, the market will be very much concerned about the election outcome. There are three possible scenarios. From the present context, we can visualize three possible outcomes from the election. The first one is the present NDA government coming back to power with a reduced majority. The second possible outcome will be a Congress-led government. These two outcomes will be well received by the market, because these two outcomes will lead to economic policy stability. But a third outcome also is possible, and that will be a sort of a third front government like what we had in 1996, a third front government with a regional leader heading the government, and with a major party not participating in the government but supporting it from outside. That will be undesirable from the market perspective. That is not a remote possibility now. A fractured election mandate can result in such an outcome. If such an outcome happens, the market can see a sell-off, even more than 10% correction in the indices are possible. So, investors should be prepared for such an outcome also. So, investors should keep their powder dry. If such an outcome happens and if the market corrects, that will be a great opportunity for buying quality stocks which will be available at very attractive rates. Otherwise, investors should continue with their present policy of stable investment, continue with systematic investments, scale up SIPs if possible, and selectively buy good quality large caps as well as good quality mid caps. 2019 would be rewarding for investors. Thank you.